Taxes at the beginning is Roth. Taxes on the way out is traditional. It gets really complicated because there's a lot of bad math out there. Welcome to the Zacc Call Money Education YouTube channel. Roth has been like my crusade. I have found over the last 2 to 3 years that people are making massive mistakes and have massive misunderstandings when it comes to how to think about Roth IRAs. This season is called All About That Roth, and the whole season is outlined. Just so you know, we had anticipated going in a different direction for season 2 to copy my previous Financial Call podcasts. As we revamp and build out the guided path, Roth has become such a hot topic with so many questions and so many people wanting to understand it better that we're bringing it to the beginning and creating an entire season just around Roth and how to understand it. I promise you that if you stick around through this season, you will understand Roth better than 99-point-something% of the population. In fact, just this episode will get you to 80 to 90% better than most people out there. So understand that it does not have to be that complicated, but you do need to understand a few key concepts to make it through the Roth understanding. And most importantly, you are hearing really bad information about how the Roth decision should be made. So that's our intro to All About That Roth as a season. This first episode, we're going to hit the Roth misunderstanding. In the second episode, we're going to go through some more advanced reasons as to why you would go one way or the other. We're going to then hit many reasons why people think about and do Roth wrong. Then we're going to hit Roth the right way. And finally, we're going to tackle the 5-year Roth rules. There are 2 5-year rules, and people get those wrong as well. So you can see this is a much broader topic than most people realize. So stick with us. The core concepts here: be aware of taxes, not afraid of taxes. That's something you have to understand. Second core concept: you are being marketed to in a way that exploits your emotions and your fear. Do not let that happen. This is not a scary thing. It's just a math calculation to get right, and then you can make very informed decisions and do an incredible job with your retirement planning. However, good marketing people out there are going to agitate you to be afraid of what's going on in order to get you to call them. So the goal here is you have to put in the work and you have to be patient with us because we're boring at times. And you're going to just have to listen to us be boring and go through this carefully. But by the end, I promise you again, that's my commitment. You will understand this so much better than everyone else out there. It's been really fun over the last 2 to 3 years to lay out these topics, and this whole season is the culmination of that. Because this is so technical and nerdy and in the weeds, I've brought one of our favorite nerds at Capita with me.
Thank you.
Tyson Long.
Thank you, yes.
How's that for an intro?
That's amazing.
Tyson Long is one of our senior wealth advisors. He helps high net worth clients at Capita when we get into hairy situations or sticky situations with regard to different financial plans and different financial situations that need somebody who can handle the complexity and roll with the punches. We throw Tyson Long in there. So today, Tyson will join me for the rest of the season for All About That Roth. And
couldn't have picked a better name for the season, by the way.
We're like
I mean,
following the
that's
Megan
what
Trainor.
sold me on coming in. So
Sure it was. Sure it was. So, okay. In order, I'm going to dive in. Do you have anything to add?
No, let's roll. I'm excited.
Okay.
Let's do it.
In order to understand any of these topics, you have to have a basic understanding of Roth versus traditional. And the key aspect of that is where you get taxed. So these are both retirement accounts. They both provide some sort of tax benefit in using them. And the reason you might use them over just saving somewhere else is because of that tax benefit. The tax benefit is I can pay taxes at the beginning and have it grow and then be tax-free. Or I can avoid taxes at the beginning, have it grow, and pay taxes on the way out. That's as complicated as it needs to be. Taxes at the beginning is Roth. Taxes on the way out is traditional. They sometimes call this tax-free money, Roth, and pre-tax money or tax-deferred money on the traditional side. It gets really complicated because there's a lot of bad math out there. And
for sure.
A quick story. So you know this presenter that I'm about to talk about because you've sat through some painful presentations with this individual as well. But we won't talk about names. I'm going to set the stage. Basically, 100 financial advisors in a room, all listening to somebody who's paid a certain amount to be at a conference to then pitch the advisors on their idea. And you know the type of presentation I'm talking about.
Yep.
But this guy throws out, he says to advisors, listen, this works every time. Here's how you get the client to progress through the sale. You put a $5 bill on the table, a $10 bill on the table, and a $20 bill on the table. And then you ask the client, which one of these do you want to pay taxes on? And he says, inevitably, they always pick the $5 bill. The problem is that's just really bad math. I mean, the idea is that you will pay taxes on the 5, have it grow, and then be able to spend a large amount tax-free later. But it's just bad math, and we're going to go through why that's bad math. But the idea behind this 5, 10, and 20 isn't Roth versus traditional. In his case, it's because I want you to buy an insurance product that then you can withdraw from tax-free. But it's the same concept. And even I was checking out different Roth resources online over the last year and ran into a Dave Ramsey video where he specifically says that Roth will kick traditional's butt, is what he says. And you can hear him saying that. And then he'll say, and then he said specifically, in order for traditional to be better, you need to be in a dramatically lower tax bracket in retirement. And then he emphasizes the word, but it has to be dramatically lower. Also bad math. 1% lower is better. So let's go through the Roth misunderstanding here. And the important thing to focus on, and most people, all they care about is how much money do I get to spend in retirement? That's all they care about. So we're going to establish something called the spendable amount. And
which is what people are actually thinking about, right? In real life, in practice, when you're out, you're spending money on what you're thinking about. What do I have to spend? That's what matters, right?
Absolutely. So in order to keep life simple, we're going to use simple math and say you're starting with $10,000 of money you can save towards retirement. And you have $10,000, and we'll go the traditional route first. So if you go the traditional route, you do not have to pay taxes on that $10,000. It's pre-tax money or tax deferred, however you want to call it. It goes into the account. And if we earn approximately an 8% return over approximately 9 years, I'm doing this because it helps us with easy math, that money will double. So you go from $10,000 to $20,000. Again, easy math. Let's say that you have a 25% tax cost getting it out. So we're sitting with $20,000 with a 25% tax cost to get it out, which means you're going to pay $5,000 in taxes and you'll have $15,000 spendable. There's we've established on a $10,000 investment in that scenario with those growth rates, that time frame, and that tax rate, you have $15,000 to spend later. Let's call it, your 9 years later.
Got it.
All right. And you paid $5,000 in taxes. So if we go the other route, which is the Roth side, and we take that $10,000 and we have to pay taxes on it in the beginning at 25%, just keeping things the same, you pay $2,500 in taxes. You have $7,500 to invest. Let's just pause for a second. This is the $5 scenario. This is the guy saying, hey, pay taxes on the 5. And in many cases, people get really excited and they're like, I won. I paid $2,500 instead of $5,000. I won.
Right.
And Uncle Sam lost here.
And I think where people sometimes get tripped up on this too is they when they try to do the same example in their head and they say 10,000 pre-tax, 10,000 Roth, but they forget to take out. They're like, I'm going to invest 10,000 in Roth or invest 10,000 in traditional. But it's like, well, to get 10,000 in Roth means you had to make more than that to get there. Now, I think people forget that part.
We'll hit that exact math error for sure. Because in the last time I've done this type of conversation many times online now, and that shows up in the comments. It's like, but 10,000, for sure, we'll hit that. Okay, so $7,500 to invest. You earn 8% over 9 years roughly, and you double it to $15,000, and then You do not have to pay taxes on the way out because it's Roth. It's all tax-free money. So you have $15,000 spendable, which is the same number.
It's the same amount.
Right, exactly. Surprise. Obviously, we both knew that. But this is actually something that can be pretty surprising to people. And for many people, when they see that it's the same spendable on both sides, it's either an aha moment or it's frustrating to them. So like, wait a second, what?
Yeah.
So it is the core of this entire conversation that if the time frame is the same, the growth rate is the same, and the tax rate is the same, you will always end up with the same spendable amount on those accounts. Couple things to understand. Your growth rate probably going to be similar based on how you invest. If you invest similar in the two accounts, time frame going to be similar. So the one variable that really, really matters here is the tax.
Yeah.
You got it. So we're going to go through the reasons people do it right and wrong. But the key thing is, if it's the same tax rate, it doesn't matter. The same spendable amount occurs. And it's funny because the fact that it doesn't matter is what matters in making this decision.
Right.
So we're going to go through 4 reasons why you might go Roth versus traditional. And all of them have to do with this concept of the same spendable if it's the same tax rate. Okay, first one, tax rate will rise. So someone who is sitting in a low tax bracket today, and in the future they're going to be in a higher tax bracket when they take the money out. Well, we had a previous chart that was 25% on both sides. If you could pay 10% today and go the Roth route, well, now you only had to pay $1,000. You had $9,000 and it doubles to $18,000. So we end up with 18 spendable versus 15 spendable. So that's
winning.
The winning. That one you really did win.
Yeah.
So if your tax rate is low today compared to what it will be in the future, so and meaning another way of saying that is your tax rate will rise, do Roth. Some people look at this and say, well, my taxes are going up. Government's going to throw taxes up for sure. And I would agree with them that there's a very high likelihood that we will experience higher rates than we have today. It's 2025. When I did this back in 2023, I was telling everybody, hey, the Trump-era tax cuts will expire after 2025. And then we were all surprised with a sweeping change in politics, right?
Yep.
With more Republican-controlled House, Senate, and presidency. So that changes things a little bit. So far, we still don't have any. It's June of 2025. We don't have any word on whether that will completely expire or whether the tax rates will continue. But if nothing happens at the end of this year, then those tax rates do go up across the board by about 2 or 3 or 4%. And I have a feeling that at this point, it's the first time that I've felt like, oh, they're probably going to find a way to extend this.
You would think so.
You would think so, based on the current government structure.
I do like the point you made, though, that I do think it's important to think about that in as fair and balanced as a way as possible. I think we sometimes can get pretty emotional and attached to a belief about what tax rates will do in the future, but quite frankly, nobody knows exactly what's going to happen. I think we can make some educated guesses on that. But with this type of analysis, too, it's really hard to make big decisions on assumptions that may be, drastically different than what we think they're going to be.
Right. And then we definitely need to separate what the government's going to do with tax rates and what is going to happen in your financial situation. So tax rates, let's talk about the second one. This will help illustrate that. The second reason to go one way or the other is you believe that your tax rate will drop. And if that's the case, you should save on the contributions today by going traditional and get the tax break today and then pay on the way out at a much lower rate. So an example of this, I was working with a doctor who was making $500,000, $600,000 a year, roughly, in a pretty tough tax bracket at approximately 30% tax.
Yeah.
And he was making Roth contributions to the 401k. This couple is very frugal. They're going to spend $80,000 a year in retirement. So they have incredible tax control in retirement, because when you have that kind of spending lifestyle, you can really control from which account you
Big
pull
time.
money and how much taxable income you show. So they're going from a 30% tax rate down to a single digit on average with maybe a 10 or 12%, probably 12% tax bracket on the last dollars they earn. So 30 and 12. And he's paying taxes at 30 when he
Yikes.
could get it out in a few years at 12.
Yeah.
That's scenario 2. Tax rate will drop. Now, that has nothing to do with the government changing taxes.
Yeah.
And everything to do with that individual's behavior and their own tax situation.
I think that's a good example. I mean, you could even use an example for number 1, simplified, but still a good example of somebody that, is early in their career, potentially in their lowest earning years. You might think that, well, they're going to be in a lower tax bracket, so Roth would make more sense then if we assume that they're going to increase their income over time and be this doctor in the future that's now in the 30% rate. Whereas in your example, as people get closer to the end of their careers, when they're in their peak earning years, that's usually when they're in the highest tax brackets, and traditional starts to make more sense.
You
which
got
has
it.
the government and tax, nothing came into the conversation about what the government's doing.
Right.
In either of those.
Even if they raise taxes by somewhere around 5 to 8% per bracket, he's still better off doing traditional today because he avoids 30 or even 35%,
Right.
and takes on 10 to 15 or so.
Yep.
So if your tax rate will drop, that's traditional. Sometimes people will say, well, don't forget about minimum distributions because that's going to push my tax bracket up. Totally get it. That's part of will your tax rate rise or will your tax rate drop? And we'll go through all of those things in these future episodes as well. Okay, the third category.
I like this one.
Do you?
Yeah, I do like this one because I think it changes the way you look at your retirement accounts a little bit. And like when you see the balance of the retirement account, when you start to look at it, when this point Zacc's about to make it.
No, you're about to make it. You do it.
No, you keep going. I want to just say I really like it because it changes the way you look at your retirement accounts.
Category number 3 is all about you want to max fund your retirement contribution limits. So it's important to understand. Let's say you have a max contribution limit of $23,500, which is the current contribution limit to 401ks and 403bs. If you can put up to $23,500, and you can choose to do that with Roth money, or you can choose to do that with traditional money. If you put traditional money in, I like to think of it as if you're in a partnership with the IRS on that money. Because while you're not, and I actually have said that before, and somebody was like, wait, you're in a partnership with the IRS? No, not like literally.
For life, until you die. Yes.
Exactly. What I mean by that is some of that money is not yours because you're going to pay it in taxes, right?
Yep.
So let's call it you're in this partnership with the IRS, and the partnership split is your tax rate. So if you are going to pay 20%, 80% of that money is really yours and 20% is theirs in a way. Again, not literally. Okay, so that's the partnership with the IRS. In the Roth money, 100% owned by you. There's no partnership with any other party at that point.
And I think that's the part that makes you think about the way you look at your accounts a little differently. Because if I've got this big traditional IRA, it's all pre-tax, there's $1 million in there. I think I've got $1 million. I really don't, because part of that is not mine. It's earmarked for the IRS in the future.
Right.
Which is, again, we don't want to be afraid of that. We just want to understand that, because even if I have a Roth IRA with $1 million and none of that is for the IRS in the future, well, I still had to pay some money to get to that point. So
exactly. So you want to max fund your contribution limits and you have this $23,500 contribution limit. If you put $23,500 into a Roth, you had to use probably $26,000, $27,000, $28,000 of your income to get it there. And then in the end, to your point, $23,500 of Roth is worth a lot more than $23,500 of traditional. So max funding your accounts, it's as if you're putting a little bit more in if you're doing it with Roth, because you're taking other dollars from your paycheck or other resources to cover the tax bill on that, and that's putting that towards retirement.
And just a teaser for next episode, future episodes, some of the money in that 401k might be from your employer, which adds another tax wrinkle to it.
Right. Okay, so the fourth category, it has to do with something that I had an engineer teach me is called degrees of freedom, which is so weird. I had this conversation with him. I laid out the strategy as to what we were trying to accomplish and why. And he said, oh, that's degrees of freedom. And I said, I have no idea what you're saying, but go ahead and explain it to me, and then I'll tell you what I think you mean. So degrees of freedom is the idea of creating an environment in which you have optionality in the future, or the choice between multiple future pathways. So you're saying, I don't know what my future state will look like exactly, but I'm going to set myself up. And some people call it future-proof. I'm going to future-proof my future situation so that I have many different pathways at that time. I'm not going to commit to that pathway today and have that fork be today. I'm going to set myself up for it. So degrees of freedom, that's what that means. We call it good marginal tax bracket management. It's not nearly as exciting
not as cool sounding,
or not as cool sounding, but that's what it is in reality. What this means is you're funding each of these tax statuses, and it's important to separate account type and tax status as we're talking about that. Forgot to bring that up. Let's go through it. Account types: 401ks, 403bs, IRAs, SEP IRAs, simple IRAs, non-retirement brokerage accounts, all of that, right? Those are all different account types, but there's really, in the retirement structure, there's really only two tax statuses: Roth and traditional. So when I say Roth or traditional, I'm not specifically referring to Roth IRA and traditional IRA. That's part of it. But we could be talking about Roth 401k and traditional 401k.
Right.
So the account type is like the government code that allows that to exist. That's why they're all numbers in 401k. And you know what I mean? And then within those, there's the tax structure or tax status, and that's Roth versus traditional. So having multiple tax statuses in retirement really creates this optionality, this future-proof environment where you have so much control. My dad's in the status or age demographic where he gets these mailers, and he'll show them to me every once in a while, and they say, hey, if you have over $500,000 in assets, you will pay over 70% away of your IRA in taxes if you don't do exactly what we say. So first of all, let's unpack that a little bit. The words, if you have over $500,000 in investments, that's basically them saying, our investment minimum to be at our firm is $500,000.
Right.
It has nothing to do with a certain level impacting their
subconscious account limit, their
right.
account minimum to work with us.
And then the second thing, so because I'm a nerd, I went through and I thought, like, could you do it? Could you really pay 70% away in taxes? Like, what would you have to do?
You mean you took the mailer and actually said, hold on, let's fact check this, and
right.
did the math.
All by myself. So I was like, how would that have to work? And you really would have to love the government to make this work. You would have to be making probably an income over $700,000 a year. You would need to have over $30 million. I'm talking about a couple. Need to have over $30 million in assets, die, pay estate taxes, and your kids would need to be making, $700,000+ a year. That's how unique and extreme that claim is. So I guess it's technically true, other than the fact that it's 0.0001% of the population or something like that. So for the rest of 99.99% of people out there, let's now talk real about what it really looks like. In retirement, I have found that individuals have so much tax control, and yet retirees are the ones that are the most afraid of taxes, more so than the worker.
That's interesting. You're right,
So there is this disconnect between the reality of how much control they have and the effect of like what's actually happening in their taxes.
Yep.
We see a lot of individuals who have a similar lifestyle to what they had while they're working. And when they were working, they were paying an average effective tax rate of 12 to 18 and maybe 20. And then when they're retired, it's between 8 and 15. So I'm not saying that that's everyone. I'm not saying that will be you. Obviously, these episodes are educational in nature. We're not talking to very specific people, but we're laying out the landscape for you.
Yep.
Okay, so this last concept, retirement tax control, diversification of tax status. So let's fast forward to the ideal prepared retiree. They're sitting there with Social Security income, and that's not fully taxed. So that's advantageous for them.
Huge.
It could be taxed at zero if you have very little other income, but as you have more income, you at least get 15% of it back tax-free.
It's very tax efficient from that standpoint, for sure.
And cost of living adjustments and Social Security is solid. Now, don't get me wrong. Like, I think most people could have built a better pension for themselves, being able to invest that money there on their own. But you didn't have a choice in the matter. It was the law, so you deal with it. But now that you're sitting there with the Social Security benefit, it does have some tax efficiencies. Okay, so you're setting yourself up with Social Security in the 10% tax bracket, maybe some into the 12. If you have a pension, most of the time that slots in at about 12%. So we're just stacking the income. And remember, we haven't talked a ton about taxes yet in the guided path, but some people get confused about these tax brackets. They think that if they cross over into the 22, all their income is taxed at 22. It's not the case. If you cross over into the next tax bracket, just those dollars that cross the line are taxed at that rate. That's what they call marginal tax brackets, the part on the margin.
Which is very important when we're talking about what, starting income in retirement, where to withdraw from. Also, Roth conversions. What's the cost of a conversion? Like, the marginal bracket is very helpful to know.
It matters so much more from a strategy standpoint. So fill up the first little section with Social Security. Fill up the next section with maybe you have rental income, maybe you have pensions, the things that are just going to happen that you don't have a lot of control over. Those fill up 10 and 12% tax brackets. Now, a lot of people have additional room in the 12% tax bracket. So now we're choosing between multiple sources. We could take from Roth, but I wouldn't at that time.
Yeah.
I would pull from traditional and pay 12% tax on it. You probably got a tax break of much more than 12 while you're working for those contributions, and you win. That's the bottom line. You win in that case.
Absolutely.
And that right there, I just want to point out, you do not need to be in a dramatically lower tax bracket. Even if you made traditional contributions at 15 or 8, saving, let's say it was the 22% tax bracket. Now, that is the biggest jump on the scale from 22 down to 12. That's a 10% drop. But the bottom line is, even if it's just a couple percentage points, even if it was from 24 down to 22, you saved money.
Yeah.
Okay. So we've got this ideal retiree. They fill in 10, 12 with Social Security and pensions or other income, and then there's headroom. And we obsess over these little differences as advisors, even if it's going to save only $1,000 for someone. That's our job, to obsess over saving just a little bit.
Gets us up in the morning.
Exactly. So we have this headroom. They could take traditional IRA money, traditional 401k money at 12%. That'd be a great use of that headroom.
Absolutely.
They could, if they have capital gains on a portfolio, sell investments at a 0% long-term capital gain bracket.
There is a 0% long-term capital gain brackets.
Right. And not a lot of people know about it.
I know. It's amazing.
So that right there, your little secret 0% capital gain bracket, you could do it right. You could pull from that right there. All right. So that would be how you would fill up the next. Now, some people will fill that up with traditional, and then as soon as they fill up the 12% tax bracket, they stop pulling from pre-tax money. And then they go over to that long-term capital gain bucket, and maybe they pay 15% on just the gain. So they might sell $50,000 worth of a stock or something like that in a non-retirement account. We're not talking about traditional Roth right now. We're talking about non-retirement, which is not part of this conversation today, but I want people to know the concept of degrees of freedom.
Yep.
So they have maybe $50,000 worth of a stock they sell. It had a $20,000 gain. They pay 15% federal on just the $20,000. Then maybe they need a little bit more, and they go to their Roths and their HSAs and their accounts that have zero tax cost. When you look at it like that, you have an individual with $150,000 to $250,000 of income per year with an 8 to 12% effective or average tax rate. Let's bring this home to, don't be afraid of taxes, be aware of taxes. And if you have time before you retire, reason number 4 to go one way or the other allows you to diversify your tax status. So it's like sitting in front of an airplane cockpit where you've got all these buttons and levers you can pull to be able to pull from different sources in retirement and really truly control your taxes.
Love it. Can I make a couple comments too, just on the degrees of freedom concept? I think as we think about building retirement plans that are going to last 20, 30 years, there's so many unknowns. And, sometimes we'll try to project and look into the future as best we can and try to manage those unknowns. But, the path of life can take us in so many directions. And I kind of think of it as like, as long as the outcomes stay in this band of possibilities, like I'm going to be okay. And I think with this degrees of freedom concept, what it allows you to do is it allows you to absorb more possibilities and widen that band of I'm going to be okay in more scenarios now, regardless of what the future holds for tax rates. If tax rates go up a lot, I've got some Roth money there to help me. If tax rates stay the same, I didn't make a big mistake by way overdoing it and putting everything in Roth and pay a ton of taxes that I ended up not needing to. Like I'm trying to control and not overdo it on the extremes either way, and give myself options is huge.
Such a good point. And the reality is you hope that you live 20 to 30 years in retirement, right?
Yep.
So to your point, to be able to handle a wide range of scenarios from a government tax policy standpoint, there's a really good chance over those 3 decades that you will experience multiple tax scenarios.
I would bet on it, yeah.
Right, like a high tax environment and a mid and maybe a low, or a low, mid, high, or something. You're going to go through these waves of somewhere between 5 to 10 years of tax policy in one way or another based on how elections go.
Absolutely.
And that's a good point, that handling a more wide variety of scenarios over time.
And I sometimes think I always get a little worried when people want to talk too much about the extremes, because the more you go into the extremes, that means the more certain you are what the future holds. And that's always a risky proposition, I think.
Let's talk about the key concept, which is we talked about not being afraid of taxes, but being aware of taxes. And then the same spendable scenario. That is so important to understand, that if your tax rates are the same, you will end up with the same spendable amount. Now, before we wrap up this episode, a couple of things to understand. You will inevitably be like, wait, what about, and however you want to finish that sentence, that's what's coming next. So there are things like minimum distributions, inheritance, your Medicare Part B premiums, government decisions. There's a huge one, which is your taxability of Social Security and how that pans out. There are 8 advanced reasons. So we gave the 4 basic reasons in this episode as to why you would go one way or the other. There are 8 advanced reasons, and that'll be our next episode.
It's going to be awesome.
We're going to dive right into it. And so if you have finished this episode and you understand the same spendable concept, you are ready to move on to the 8 advanced reasons.
This is just whetting the appetite. I'm really salivating for the next one.
This is why we like Tyson. It's because he loves this stuff. Anything else you might add?
No, I love that. I think it's the foundation for understanding the advanced reasons to Roth or not to Roth, is remembering, going back to the simple example Zacc gave of, the spendable money, and if the tax rate's the same, it's the same spendable money. It doesn't matter, but it's the tax rate changing that influences the decision.
Right. Okay. And after we get done with the advanced reasons, we're going to go into all the ways people think about it wrong. And those ways that people think about it wrong, there's 15 of them I have listed here. By the time we record, maybe there'll be more. We'll see. But 15 of them, and they all come...
That's being generous. I mean, there's probably 20 or 40.
There's probably more. But they all come from people saying like, oh, no, it's this way or it's that way, or just finding different people, talking heads online that I fear are leading people astray. So stick around. Follow us here. We're going to help you through all of it. It's all about that Roth.
Love it.
Thank you for joining us today. You can find more information about Capita Financial Network and any disclosures in the link below. It's important that you understand Roth. We are excited to have you. Make sure you subscribe and follow us so you can learn all about that Roth.